In our previous lecture, we have discussed product cost under absorption costing and under variable costing. Now, in this, we will compare the income of absorption and variable costing. To illustrate the computation of unit product cost under both absorption and variable costing, consider ABC company, a small company that produces a single product and that has the following cost structure. ABC is a company, it has only one product. They are producing only one product. They have no more than one product. So the number of units produced each year, on this they produce the units each year 6,000, right? This is not the cost because there is no currency unit and it has already mentioned the number of unit produced each year, that is 6,000. Variable cost per unit: direct material $2, direct labor 4, variable manufacturing overhead 1, variable selling and admin expense $3. These all are the per unit cost, right? Fixed cost per year: fixed manufacturing overhead 30,000, fixed selling and admin expense 10,000. See, in the previous lecture we have done, or we have calculated the product cost, right, from this data or from this data. So what was my product cost under absorption costing? That was 12, and in variable costing that was 7, right? Okay, now the additional data is given here, that is units in beginning inventory, that is 0, units produced 6,000, units sold 5,000, units in ending inventory 1,000. Obviously, if we are producing 6,000 units and we are selling 5,000, so what is on my hand? It is 1,000. 6,000 minus 5,000 is equal to 1,000. It means in ending inventory I have 1,000 units. Selling price per unit is $20. Selling and admin expense variable per unit $3, and fixed per unit, fixed per year is $10,000 unit. This value is in total, right? This value is in total. Again, see, this value is in total, right? Okay, prepare income statement under absorption and variable costing. First we will prepare the income statement under absorption costing. How we can prepare the income statement? In the previous work we did sales less cost of goods sold equal to gross margin, and then we subtract or we deduct the operating expense and we got net operating income. Again we will do the same things here, but how? Let's see. We first write about the unit product cost, which is already done in our previous lecture. We have calculated, right? That was 12, right? Because unit product cost is very necessary in this at every stage when we are calculating the cost of goods manufactured or we are calculating the ending inventory cost, right? So what we required, first we want to calculate the unit product cost, and in our previous lecture on previous work we have calculated the unit product cost and absorption costing. Again I am telling you in this slides how I calculate this unit product cost under absorption costing: direct material, direct labor, variable manufacturing overhead, and fixed manufacturing overhead. And how I got per unit? 30,000 divided by 6,000 equal to 5. So my fixed manufacturing overhead per unit is 5, right? 30,000 divided by 6,000. So what I will do in absorption cost and product cost, if I want to find the product cost under absorption costing, I will add all the values: direct material, direct labor, variable manufacturing overhead, and fixed manufacturing overhead, right? So my value is 12, right? So again I told you about how I calculate this 12. Okay, now in income statement, first we can take the sale. What we do? we will take the sale. Okay, what is my sale? How I will know? The unit sold is 5,000. Look here, the unit sold is 5,000 and the selling price per unit is 20. So 5 twos are 10, mean 5,000 multiplied by 20 is equal to 1 lakh, right? What you will get? You will get 1 lakh dollar. Okay, less cost of goods sold. Cost of goods sold, because this is my manufacturing company, right? So my cost of goods sold, how I will calculate my cost of goods sold? First I will take beginning inventory. Okay, where is my beginning inventory? Units and beginning inventory is 0. So if anything is multiplied by 0 is 0, it's mean there is no units in beginning inventory. So we will take as in beginning inventory is 0, right? Okay, cost of goods manufactured. How I will calculate my cost of goods manufactured? You can see here the unit produced, that is 6,000, right? Unit produced 6,000, and my per unit cost, again I will use this unit product cost for calculating the cost of goods manufactured. So it becomes 6,000 multiplied by 12 is equal to 72,000, right? Okay, now I will add my beginning inventory plus what I have manufactured. So what I will get? Goods available for sale. So I have 72,000 inventory for sale, right? Your goods available for sale. Okay, I will deduct ending inventory, right? My ending inventory units, or you can see here the units and ending inventory is 1,000. So 1,000 multiplied by 12. Again we will multiply by 12 the unit product cost, or with the unit product cost, what I will get? I will get 12,000. So after deducting this ending inventory from my cost of goods sold, what I got 60,000. 72 minus 12 is equal to 60,000, right? So my cost of goods sold is 60,000. Okay, how I got gross margin? We know that sale minus cost of goods sold is equal to gross margin. This is just for your convenience. So how I got this 40,000? So I write here sale minus cost of goods sold is equal to gross margin. My sale is 1 lakh and my gross cost of goods sold is 60,000. So my gross margin is 40,000, right? Okay, after calculating gross margin, what I will do? I will deduct my non-production expenses, non-productive. Take a non-production expenses. These are the production related, these are non-production related. So I can say here that I am deduct selling and admin expense, or I can say here the period cost, or I can say here the non-production cost, or I can say here the selling and admin expense. So what about my selling and admin expense? Check it. My selling and admin expense, is, look here, variable and fixed. Obviously it will be both. So fixed selling and admin is 10,000. What about variable selling and admin is $3, right? Or you can see here again the variable per unit, that is $3. It's mean my fixed selling and admin 10,000, both are same, right? You can write here in that way, or you can write here in that way. Okay, fixed selling and admin 10,000. Again I have 10,000 my fixed. Okay, but what about my variable? So number of variable per unit, it's 3, and how many units the company sold? That is 5,000. So 3 into 5 become 3 5s are 15,000. 3 multiplied by 5,000 is equal to 15,000. So here you can see here 5 into 3, this is my variable, plus 10,000 is my fixed. So when I calculating, or I got total selling and admin expense, what I will get? 5 3s of 15, that is my variable, and 10,000 is my fixed. So total becomes 25,000. Okay, now after calculating the selling and admin expense, I will deduct it from my gross margin. Gross margin was 40,000 and selling and admin expense is 12,000. So my net operating income is 15,000. 40,000 minus 25,000 is equal to net operating income, right? I'm again here writing less, right? So what I will get, less cost of goods, और यहाँ पे लिखने की ज़रूरत नहीं है again. So less selling and admin expense 25,000. What I got 15,000, right? So my net operating income under absorption costing is 15,000. So I have prepared the income statement which is based on absorption costing. Now we will move towards the variable costing. Okay, on the variable costing or in absorption costing and theory we have discussed, this is my conventional or the traditional approach where I incur or I take the cost of fixed manufacturing overhead in my product cost, and we have seen here the 5 fixed manufacturing overhead, right? That's why here our product cost is 12, and in the variable costing we have discussed that that was 7, right? Again I am showing you how I calculated. So in variable costing income statement, the unit product cost is 7. How I calculate? 2, 4 and 1. What is 2, what is 4 and what is 1? Again see here the variable cost per unit. The direct material is 2, the direct labor is 4, and the variable manufacturing overhead is 1. We will not take the fixed manufacturing overhead, right? We will consider only the variable proportion of cost of product cost, that is direct material 2, labor 4, and variable manufacturing cost is 1. So 2, 4, 1 is equal to 7. So what we have done in the variable costing for product cost, unit product cost, and the variable costing is 7, that is 2, 4, 1. Already we have discussed in our previous lecture, right? But here I thought I should tell you about it where I got that 7. That's what I'm telling you, right? Okay, now sales. What is my sales? Go again on back, again move towards the question. My sales, units sold, how many units are sold? That is 5,000, right? And per unit, selling price per unit is 20. So 5,000 multiplied by 20 is equal to 1 lakh. Again I got 1 lakh. So my sale is 1 lakh again. Yes. So acha, now remember the contribution income statement, the contribution format income statement. Sales minus variable expense equal to contribution margin. Look here, the sales is there. Look here again, the sale is there, and my all variable expenses there, the variable cost of goods sold and variable selling and admin, right? There is 2 types of variable cost. One is variable cost of goods sold and variable selling and admin, right? We will deduct these 2 from our sale. What we will get? We get the contribution margin, right? And after contribution margin, what we did? We subtract the fixed manufacturing overhead and the fixed selling expense, right? Selling and admin expense. Fixed expense, after deducting contribution margin, first got contribution margin, then deduct your fixed expenses, all fixed expenses. What we got? We get net operating income, right? And how we did it? Again I want to show you. Sales less variable expenses, right? First we will calculate all variable expense, or I can write here the less all variable expenses. And variable in first variable expense, the first one is a variable cost of goods sold, right? And the second one was the variable selling and admin expenses. Okay, the variable, how I calculate the variable cost of goods sold? Again, the beginning inventory here, that was 0, and here that was 0, right? Or we can check here an additional data, that is units and beginning inventory, that is 0. Anything which is multiplied by 0 is 0, right? So there is no beginning inventory, right? So look here, there is no beginning inventory, that is 0. Clear? Okay. At variable manufacturing cost. Okay, here we calculate the cost of goods manufactured, but in the variable costing we, or in our this technique, we will use the variable manufacturing cost, right? Not the fixed manufacturing cost. Okay, remember this point, this is very important, right? Variable manufacturing cost. So my variable manufacturing, so my units which are produced, that is 6,000, and my unit product cost was 7, right? So multiply by this 6,000 unit, multiply by 7, so what we got 42,000. Okay, we will add from my beginning inventory, so my beginning was 0 plus 42,000. This is my variable manufacturing cost. What I got goods available for sale, that is 42,000, right? Okay, now less ending inventory. In the previous work, my ending inventory was 1000 unit, okay, but here the per unit product cost was different. Okay, now calculate here. My units in ending inventory is 1000, right? Again, I will take my 1000 as well and my ending inventory, and what is my unit product cost, that is 7. So what I will do, I will calculate, multiply these two terms, 1000 into 7, that is 7000. So after deducting ending inventory, what I will get variable cost of goods sold. So my variable cost of goods sold, 42,000 minus ending inventory, this is equal to 35,000, right? So my first variable cost of goods sold, my first variable expense is 35,000. Okay, now I want to calculate my second variable expense, that is my variable selling and admin expense. See here, again in question, check here, variable selling and admin. Variable selling and admin cost per unit is 3, and how many units were sold, that is 5,000. So what I will do, I will multiply this 5,000 multiplied by 3. 5 3s are 15. So my variable selling and admin cost is 15,000. So how I prepare the contribution income statement? Sale minus all variable expense. So again, what I will do here, sale minus these two expenses, right? These two variable expenses, one is variable cost of goods sold and another one is variable selling and admin expense, right? So what I will get, I get contribution margin, and my contribution margin is 50,000, right? 1 lakh minus 35 minus 15, which is equal to my contribution margin, that is $50,000, right? Here one time I have showed the dollar signs mean in these all values, the values are dollar, right? Okay, fixed expenses. Now deduct fixed expenses. How many types of fixed expenses are here? Number 1, fixed expenses, fixed manufacturing overhead, that is 30,000, and fixed selling and admin, that is 10,000. So my fixed manufacturing overhead, that is 30,000, and my fixed selling and admin expense, that is 10,000. So 50,000 minus 30,000 minus 10,000, total equal to net operating income, which is equal to 10,000. The important thing which I want to tell you about, that look, the difference. Net operating income in absorption costing is 15,000, or you can see the greater, right, than the variable costing. In variable, that is 10,000, right? There is difference of 5,000, right? We can say there is a difference of 5,000. Okay, see, my per unit cost is 12 in absorption, and my per unit cost is 7 in variable, right? Unit product cost. So the difference is 5, right? 5 per unit. Okay, and my ending inventory is 1000. If I multiply my ending inventory, ending units with 5, it becomes 5,000, right? Or you can see here, my cost is increases by 1000 into 5, right? 1000 is my ending units, or 5, right? 5000, this is greater, 12,000, right? And this is 7,000. See here, the difference is again, you can see here, the 12 minus 7 is equal to, the 12 minus 7 is equal to 5,000, and my net operating income also increases with, in absorption costing, is 5,000. So what I want to tell you, the fixed manufacturing overhead is absorbed in absorption costing method. That's why the net operating income is greater than the variable costing system. That's it.